Pete always loves that, Mark. I'm sure you do too. That's the clapper, folks. And you are tuned into The Rebel's Edge. Our producer today, as usual, is Jared. Marc LoPresti and I will hopefully both entertain and inform you as to what's going on this special 124th episode of The Rebel's Edge. Mark, thank you for joining today. Boy, Mark and I have been doing a lot of Twitter spaces too, folks, and some of them with 36,000 people in the space. So thanks to all of you that join. Make sure that you share this with some friends. And let's dive right in, Mark, to the macro minute, shall we?
Yeah, absolutely, John. And thank you for having me in place of the handsome and talented Pete Najarian. And we're going to do things slightly differently today, folks, in light of what has gone on in some activity. Of course, you've heard about Silicon Valley Bank being taken over by FDIC regulators on Friday, Signature biting the bullet, regulators determining that the bank was not sound enough and posed a systemic risk. So taking SVB off the table, John and I fielding tons and tons of questions from followers and investors. What's next? Is there another shoe to drop? Are there other banks that might fail? And are there opportunities that are being presented with even major money center banks, big so-called wirehouse banks, taking it on the chin as investors try to determine what to make of this whole situation? So, John, thank you for having me. And as we've been doing since the news broke, John and I have been tirelessly, as he mentioned, on Twitter Spaces, podcasts, all various forms of medium where we shared the airwaves with the likes of Bill Ackman and Mark Cuban, and just some really remarkable conversations throughout this crisis, and hopefully crisis averted.
Right. And obviously, for those of you who don't know more about Mark's background, folks, he was both a trader and a lawyer, a hedge fund lawyer, a venture investor. So there's really not a lot of people that have as much cred as he has in the space about what just happened. And, you know, you've got a massive bank, 16th biggest bank in the US, fails. It failed because they had very poor risk parameters. And Mark, maybe if you tell people just a little bit about that, as far as when a bank gets capital, folks, it would love to just lend it out and make a % or 2 or 5 between what they're paying depositors and people they're lending money to. But banks also buy paper, various government paper, 1 year, 3 year, 5 year, 10 year, blah, blah, blah. What happened in this case with Silicon Valley Bank?
Well, you know, John, this is sort of a classic asset liability duration mismatch, right? Yeah. So, you know, we think the logical thing is more deposits are good for banks. And that is generally speaking true. But the origin of what happened with Silicon Valley Bank has to, like most wonderful things of the past few years, go back to the great COVID-19 pandemic. And what am I talking about? All of that helicopter stimmy money caused deposits. Thankfully, a lot of people saved that money, and corporations as well, put that money in the bank at a rate that was unprecedented in 40 plus years of data that we saw increase in bank deposits starting in 2020. But the banks are not able to underwrite and loan that money out as quickly as it comes in. It's just fundamentally not possible unless you do some of the haphazard, easy money, no doc lending stuff that got us into trouble during the last financial crisis. And of course, there were a lot of parameters put around that to prevent that from happening. So banks like SVB, is what John said, they loaded up on paper, primarily treasuries, but also MBS, mortgage-backed securities. And but you got to get that right? And as interest rates change, and another thing people ask us all the time, rising rates are generally a good thing for banks, right? When we were seeing the pivot and from risk on to risk off assets, and the rising rate chain start to flow, we talked a lot about having a positive impact on banks, because that's generally the case, but not the case with Silicon Valley Bank, right? So as interest rates rise, bonds tend to decline in price. And so if banks are holding large portfolios of these bonds, like SVB and others, they suffer unrealized losses on those assets. But of course, John, when you have the kind of concern run on the bank type situation with Silicon Valley, that's not a good thing because that snowball starts to go downhill.
Yeah. And like you said, the mismatch in duration means that they have a bunch of 1 year, 3 year, 5 year, 10-year paper on their books. They don't have to take the loss on that until they sell because they could hold it to maturity. But instead, of course, they started selling before they raised capital. And all of a sudden, their balance sheet went from this to this, that fast. And that's why when Mark and I say, folks, that depositors should be protected because it's their money in the bank. They didn't make stupid investments. They may have been stupid, or they may have had a gun to their head from Silicon Valley Bank to only deal with them, or they won't raise money for you and so forth. But this was not risky trading. It was not ninja loans and all that kind of stuff.
Right.
It was that mismatch in duration. That's what took them down. And once the run started at the other banks, First Republic, Signature Bank, Zions, all of those, well, they may not have a mismatch in maturity, but nobody has enough billions of dollars to give to the depositors that want to withdraw that money as quickly as possible. So we ended up with this horrible bank run that got solved somewhat, I guess, yesterday, Mark, but there might be more to come.
Yeah. Well, I mean, because, it kicks off a vicious cycle, John, right? Because banks at a time when they need to potentially shore up their balance sheets are seeing precipitous drops in the prices of in their stock, right? Which of course is something that we're going to talk about to try to redress those questions of, is this, should I be starting to look at buying at some of these stocks? And we're going to talk about that. And John, one of the things that I've been hearing a lot about in terms of trying to determine what banks are most likely to survive this and maybe are a good buying opportunity is their correlation to bonds. Some of the research that I did over the past couple of days, 3 of the 10 bank stocks that had the strongest correlation to the bond market over the past year are the 3 that actually were shut down, right? If talking about Silvergate, SVB, and Signature. What does that tell us as we see 2-year yields declining?
Yeah, well, it tells us that the rich get richer as usual, because Jamie's going to get something. Other of the too big to fail banks like Citi and Bank America are going to get pieces of this. This is a windfall to them, but it's clearly a huge loss for regular Joes and Janes, as well as it's not just Silicon Valley bigwigs like Marc Andreessen of Andreessen Horowitz or any of those. This is beyond that. And bank runs end up affecting all of us with car loans, defaults, credit cards spiraling, people borrowing basically with their credit cards because they have to.
At a time when credit card balances are at a pre-pandemic high and the national savings rate is at a 45-year low based on the last time we looked. And that was before Friday and all of this got started.
Right. Well, one of the things that everybody looks for, folks, for this part of the show, the fantastic futures, is the CME, because the Chicago Mercantile Exchange, they actually do give us the first heads up on what's going on. You could look to Europe, you could look to the Far East, Japan, and so forth to see what's coming. But you can also, 6 p.m. Sunday evening, we were all waiting to see the reaction in the market, which was a very positive reaction because by then we'd gotten the news that many of these banks were going to be protecting the depositors. That's the FDIC was doing that. But the CME was certainly one of the great bulwarks of capitalism by being able to show, were people panicking or were they buying? And Potter wasn't selling, Potter was buying, at least last night. And so, that's one of the reasons we track those fantastic futures, right, Mark?
No, there's no doubt. And listen, in all of those tireless Twitter spaces that we did throughout the weekend, sometimes at odd hours, there was one universal sort of Mangano line, right? A drop dead date by which everybody universally said that the Fed had to speak and act with some degree of credibility. And that was that 6 p.m. Sunday CME Futures Open. And of course, the Fed coming in with its FDIA, Federal Deposit Insurance Act backstop just shortly after that important 6 o'clock time went ticked over on Sunday.
Yeah. Well, and normally, folks, I know many of you who watch regularly know we have a clock running. We don't have that clock today not because we want to stretch it out, but because some of these topics are going to be quick. Some of them are going to be longer, like the macro minute. We actually gave it several minutes today because macro really was important today. But now let's dive into some of these, Mark. KRE, this is the S&P 500 Regional Banking Index. This was in the mid 50s last week. They came for the 50 puts. They came for the 47 puts in March and April. Those were both home runs. And now they're coming for the April 43 puts when the stock traded all the way down below 43 this morning. But I'm thinking if this thing calms down a little, Mark, I want to have a call spread on to take advantage of that. Maybe not yet, but I am getting my my powder ready.
Yeah, no, agreed. And something that obviously you and I talked about a lot this morning, even in terms of our own portfolios, if it's time to start looking at putting that trade on. And I am certainly sort of watching tick by tick here because I think it is starting to become ripe. But certainly, if you just looked at that bearish put roll in the KRE that you just described, a lot of smart money investors think there's still room to the downside.
Sure.
For the region.
Ally Financial, folks, same thing. I mean, last week with the stock at 28.5, they were buying the 25 puts, $1.50 beneath the market. Today, the stock craters down to almost 21. It was a winner last week. It's a bigger winner today. And guess what? They rolled puts down in this one too. 4,000 of those April 20 puts have been purchased today, early in the morning, as you see there. Ally does car loans and a whole bunch of other things that might be impacted by consumers basically holding back, trying to keep their powder dry. What do you think of Ally here, Mark?
Yeah, that and or moving their cash to the larger money center banks. I mean, look, we have some very strong relationships with, the JP Morgans, the Merrills, the Morgan Stanleys of the world. And I got to tell you, there was lots of chatter and lots of emails and text messages that I personally received from folks asking, hey, I've got money in different regional banks, primarily because of the relationships of their local businesses, well in excess of that FDIC famous $250,000 insurance limit. Should I be moving to a JP Morgan, a Morgan Stanley, a Chase? And we're going to see a lot of that if it has not already happened. And I think it already has happened this morning. Frankly speaking, there's lots of wire transfers flying around the street this morning on the back of this news. That is not good for the smaller secondary and tertiary banks like Ally. So I think this is a good trade that's going to pay off, unfortunately.
Yep, I'm right there with you. And we're seeing, and by the way, folks, I'm going to join Charles Payne today at just after 2 p.m. Eastern time on the Fox Business Channel to talk about, he wanted to know, well, what are people doing as far as protecting themselves? They were buying puts in the regional banking index. We already covered that. They're also buying puts in the SPY, the SPY, 29,000, that's 2.9 million share equivalent. That's a big trade. And they're buying these puts for over $6 at the April 363 strike. And that's $20 nearly below where the S&P is right now, Mark. It was at 382 when they were buying these 363 puts, again, out in April. But 2.9 million, let's just round it up and call it 3 million share equivalent times $6. That gives you an idea. These are big trades that people are putting on to protect their portfolios. And I don't think that's dumb money. I think that's smart money, Mark.
Yeah, I would agree with that, John. And look, the VIX peaked at around 31, and of course it's back down into the 20s now. What is that telling? Help our viewers understand. What is that telling us about what the smart money thinks in terms of the volatility for the immediate future?
Right. Um, Number one, it told you that there was a panic and people
Right.
were trying to buy, and they did buy. S&P 500 protection, because the VIX tracks the S&P 500. It's not the volatility metric for the Russell or the QQQ. The
Right.
VXN, in fact, is the tracker of the volatility for the QQQ, which is almost always higher than the S&P 500 for obvious reasons. But the fact that it's still holding on to an 11% gain today, Mark, tells you that there are some people who probably need and or want protection against a downside slide here. I mean, I looked at the overseas markets this morning, Mark. They were imploding.
Yeah.
Germany was down 3%. We've not seen anything like that here. Today, we're basically flat at mid-session, mercifully, because of what the Fed did, what the Office of the Controller of the Currency did, because of what FDIC and FDIA and all that kind of stuff. I mean, we're lucky that adults came at this problem rather than just letting the market twist, because again, the people that got hurt were the banks and the people who owned equity and or bonds in those banks. The depositors didn't do anything wrong except that they had too much money in the bank. And that's something that we all hope to be guilty of.
Right. Right.
I mean,
So the short version, John, is that some smart money out there expects the choppy waters to continue, and they're buying downside protection, as evidenced by this particular bearish put roll that we're covering in the SPY.
absolutely. Well, how about this one, folks? Huntington Bank shares, HBAN. There's put buying in there. Now, it's not as huge as it was in some of the others, but this one isn't as widely followed either. Stock was $11 and call it 25 cents. They were buying the April 10 puts, obviously about $1.25 below where the market is trading.
Right.
But the fact that they're still buying puts in some of these banks tells you that there's still concern on investors' parts, and there's still a predatory trade by hedge funds and other smart money that are going after puts in almost every regional bank.
Yeah, it's a similar story with my unusual today in a bearish put roll in Coop, COOP, Mr. Cooper. That is sort of a specialty mortgage lender. Investors buying 12,000 of the June 35s and another 12,500 of the April 4250s. Stock around $39 as we were going on air. And when it comes to these smaller secondary mortgage specialty banks, you've got a similar concern around depositor outflows from those places to others. And, similar to what you were saying with Silicon Valley Bank, if you get a loan from one of these banks, they typically want you to have a deposit account for that bank. Sort of acts like a lockbox, right? Money in, money out. Mm-hmm. If we see money start to flow away from these less well placed from a balance sheet perspective to the larger money center banks, it's going to continue to put pressure on names like Coop. So I like, again, unfortunately for the macro outlook, but I like the trade.
I agree. And the fact that they made money and rolled down is another reason to pay attention to that trade, as well as the size. 12,500 is 1.25 million shares. That's a big trade.
That's right.
All right. For sports today, since Pete's on the road right now, Mark and I are going to cover sports rather quickly. But Bud Grant, great guy. I worked for him at Vikings training camp, Mark, for 4 years as a Ute. When I was 13 until I was 17, I showed up at the Vikings training camp, and this guy was like just a father figure, a fantastic guy. Just to give you a quick rundown, folks, I believe he was a three-sport All-American. He played football, basketball, baseball at the University of Minnesota, Pete's alma mater. He is legendary for winning 4 Grey Cups up in Canada. He's drafted by the NFL and the NBA. When was the last time, Mark, somebody was drafted by the NFL and the NBA or Major League Baseball?
He's like the original Bo Jackson, this guy. I mean, this is unbelievable. Was he also like a snooker pool champion on top of it too? That's unbelievable.
Perhaps he was. I don't know that part. But a wonderful man, great family. He was typical Minnesota, because here's a guy who would go out hunting before games and things like that.
Wow.
When you have people like that, like Holmgren or Bud Grant, those are very special people. And we're going to miss you, Bud, but really appreciated being around him for as much as I was able to be. All right, Mark, I've got Lamar Jackson getting that franchise tag, which means he gets a blended rate of what the quarterbacks get at his position, but he's getting $32 million. Lamar Jackson, if he were a true free agent, and they couldn't put a franchise tag on him, I think they can only do that once, by the way, he'd be getting $50 million a year, I believe, because he's that kind of player. But look at these other players, Geno Smith, Derek Carr, Daniel Jones. These guys are getting 37 to 50 million a year. That's why I say a guy with Lamar Jackson's talent would have got substantially more, but the franchise tag is going to hold him back. And I guess you and I wouldn't play for 32 million, Mark, but
I wouldn't take a penny under 35 personally, John, with my skills. No, come on.
Well, given your skill set, of course. Folks, we really appreciate you joining us today. We'd like to talk just a little bit about one of our clients. Mark and I have worked with this company. I'll let Mark take it, but Verijet, fantastic carbon fiber, very safe with a parachute in the roof, a lot of AI and all the rest. This is a company that basically, it's a jet charter business using one of the safest jet aircraft ever made. And I love Richard and his team at Verijet too, Mark.
Yeah, you listen. You said it right, John. And today's Rebel Edge brought to you proudly by Verijet. As John mentioned, this is a company that uses exclusively the Cirrus SF-50 jet aircraft equipped with parachute and an artificial intelligence-based landing system if something should happen to your pilot. And the reason that we like this, apart and aside from the fact that it's an incredible plane to fly and to use, is that from a business perspective, this company is filling in options for business travelers, but also leisure travelers, for smaller range regional flights that have all but been abandoned by the majors. If you're going from Miami to Naples, you don't want to have to do it by way of Dallas, but you might have to with American Airlines or Delta. So folks, please check out Verijet, www.verijet.com, and very thanks to our sponsors.
Thank you, Verijet. Thank you, Marc LoPresti. I'm sure we'll be back maybe with a Twitter space tonight.
Yes.
To talk about, the impact of the market. So make sure you follow Marc LoPresti and or me, and hopefully you'll join us in a Twitter space this evening. So to all of you watching, thank you. Very special 124th episode of The Rebel Edge. We'll see you at Fox Business a little after 2 p.m. this afternoon.
Introducing our new series of intimate in-person trading conferences in some of the greatest cities in America. It's Market Rebellion Live. Next up, this June in Sonoma County, California. Savor some of the finest wines in America while you level up your trading with Pete Najarian, Jon Najarian, AJ Monty, Ryan Mastro, and Bill Johnson. Sonoma is limited to just 25 seats to ensure every guest gets personal attention, so act now. Tickets are going fast.